Good afternoon, everyone. Welcome to another session of BDO Securities Trade Talks tutorial series on the basics of fundamental analysis. I am Rachel Cruz, Research Analyst of BDO Securities, and I will be your host and moderator for this afternoon's event. Before we proceed, let me share a few reminders. Attendees are in listen-only mode. We will be entertaining questions right after the presentation. However, should you have any questions in mind, you may send it at any time through the Q&A box located on your Zoom screen options. Without further ado, let's now welcome our featured speaker for today, Ms. Bettina De Hoya, Assistant Vice President for Corporate Finance of BDO Capital.
Hi, good afternoon, everyone, and welcome to this session of BDO Securities Trade Talks. So today's topic will be the basics of fundamental analysis. By the end of this session, we hope that our audience would better appreciate the following. First, the what, the concept of fundamental analysis, its objectives, and how the tool is used for stock analysis and trading. Next would be the how. How exactly does one apply fundamental analysis? As we look to cover the basics for this session, we hope to establish the framework that will guide our analysis without overwhelming ourselves with all the formulas. And of course, now what? Even if we are just covering the basics for this afternoon, given what we will find out later, how then do we use this knowledge to improve our trading strategy moving forward? So what is fundamental analysis? When we say fundamental, we usually mean we are looking into the foundation or into what is at the core of something. In finance, fundamental analysis is a method used to determine an asset's intrinsic value. We are interested in finding out the value of what is inherent or underlying in that asset. Analysts refer to this as the fair market value. The exercise of fundamental analysis aims to calculate the value of an asset without factoring in market sentiment or without being influenced by what the market says that asset is worth. So that is, in stock trading, fundamental analysis asks the question, is this stock really worth its current market price? Now, why is this question important in stock trading? This is because the answer could help us identify opportunities in the market. So because fundamental analysis strives to calculate the intrinsic or fair market value of a stock, it can tell us whether such stock is priced just right or whether it may be under or overvalued. Among the most practical applications of fundamental analysis is this: spotting strategic trading opportunities whenever there is a mismatch between a stock's fair market value and its current market price. So in simpler terms, when the intrinsic or fair market value of a stock is equal to its market price, we can conclude that the stock is priced fairly or just right. When the fair market value is greater than the market price, we can say that the stock is undervalued, and investors may consider this as a signal to buy or increase position. Conversely, when the fair market value is less than the market price, analysts may say that the stock is overvalued and advise investors to consider selling or decreasing their holdings of that stock. So now that we've covered the what's and the whys of fundamental analysis, we now move forward to how. How exactly does one conduct fundamental analysis in equity trading? We know that there is a whole host of different factors that can affect the price of a stock. We also know now that fundamental analysis focuses only on what is intrinsic or truly relevant to the stock. And we are most interested to know how each factor may impact the fair market value of a company. Because of all the points that need to be considered, the task could feel a bit overwhelming. The factors on screen are not even an exhaustive list of what these factors could be. So to make the assessment more manageable, analysts usually follow a framework that studies these factors in orders. First would be economy, industry, and then company. Analyzing the economy means looking at macroeconomic indicators such as interest rate movements, foreign currency exchange fluctuations, inflation and GDP growth, and even government fiscal policies. These indicators provide a backdrop for understanding the overall economic environment in which a company operates. These data points are typically compiled, calculated, and or reported by government agencies. Here in the Philippines, these are usually published by the BSP, the Philippine Statistics Authority or the PSA, and other similar entities. So given economic developments, a fundamental analyst may want to ask, what does this mean for the overall market? Will there be specific industries that might be more affected than the others? Will the impact be positive or negative? And by how much? So even if these factors may seem too broad or abstract, impact from economic developments often actually trickle all the way down to industries, companies, and eventually to individual consumers or end users of products and services. We move on to studying the industry. While different industries will of course have varying relevant industry factors, certain aspects of an industry can usually be characterized by 5 factors. Analysts use a model called Porter's 5 forces. This framework attempts to determine the underlying drivers of value within an industry and how each component affects the competition among the existing players. The key premise is that the interplay of these factors ultimately influence the profitability of that industry. These 5 forces are the bargaining power of suppliers. It asks, how strong is the supplier's ability to charge higher prices? Do the sector players have a lot of options to source their inputs from? And there's also bargaining power of buyers, which asks, are buyers capable of driving the prices lower? Or are they capable of demanding better products or services for the same price? Because when the bargaining power lies with either the suppliers or the buyers and not the companies within an industry, we can expect competition to be more intense as players will fight hard to increase market share to make profits. There's also the threat of substitutes. Can customers easily find substitutes or alternatives for this industry's products? When a new product can address customer needs in a more efficient way, industry profitability will likely suffer. So if you would recall, during the pandemic, it forced realizations around cost-efficient substitutes. So for instance, video conferencing became the norm instead of traveling, and working from home became prevalent instead of reporting to offices. There is also another force is threat of new entrants or new players. The question here is it easy for new players to penetrate and come into the industry? Are the industry's goods easy to produce or replicate? The threat of new entrants coming in may force current players to keep their prices low or even spend more to retain their customers. And last is the rivalry among existing competitors. It asks, how fierce is the competitive landscape? This is because intense competition may lead to price wars or may require stronger marketing efforts. And both of those factors will actually put a pressure on a company's margins. And as the diagram implies, pressure from the four other forces can actually further intensify competitive rivalry and in turn put more pressure on a company's profitability. Industry-related factors include sector trends and developments, competitive landscape, the regulatory environment, and other factors that are unique to the industry, such as its customer base, technology, presence of substitute products, and business cycles. So guided by Porter's 5 forces, industry analysts will seek to answer questions such as, what does this mean for the value chain? Could it affect supply and input costs? How will it affect demand and sales? Will this development invite more players into the sector or drive some of them away? And will this drive customers to turn to substitute products or consider alternative services? So now we dive into the company itself. This is where we study a company's business model, operational capabilities, financial conditions, management and governance, and company actions such as mergers and acquisitions, for instance. For company-specific information, we rely on their corporate disclosures. These could be in the form of periodic reports, such as their quarterly and annual results and financial statements, or they could also be disclosures on material information or transactions. Some company-specific information may also come from news reports. So company disclosures are documents that are available for public to view and download from the TSE Edge portal and sometimes from investor relations websites of the companies. In our review of the company, the questions that we would like to answer are, what drives company growth? To truly understand a company's business model means knowing how a company makes money so that it could further grow the business. So we need to understand, what are the company's inputs and outputs? How does it generate revenues? And what does it need to spend on? There's also operational capability, where we want to drill down on how well a company does versus its objectives. To quantify this, people often look into key performance indicators. These are not necessarily financial in nature, and these could oftentimes be operating metrics. For example, for retailers, they track number of stores or branches, and some retail operators also track same-store sales growth. Some utility companies would track their number of customers, and for example, Meralco, it tracks electricity sales volume in gigawatt hours. So those are not financial information, but they are important metrics to gauge the performance of a company. Property companies that have office or mall components, they typically track floor areas and occupancy rates. So of course, in-depth company analysis will require us to delve into the nitty-gritty of the company financials. Analysts turn to financial ratios to distill information into figures that may be compared against past performance. like within a company, to find out how it has fared from one accounting period to another. The ratios will also allow us to compare financial performance among different companies, whether within a sector or even against another company in a totally different industry. Studying financial statements also form the foundation of valuation exercises. Most of the time, fundamental analysts prepare financial models. So these are usually in the form of Excel spreadsheets and workbooks that lay out a company's historical financial statements. So those would be its balance sheets, income statements or P&Ls, and cash flow statements. Laying these out to come up with projections and forecasts based on what they know from studying the company, the industry, and the economy. Fundamental analysts rely on various valuation methodologies to arrive at the fair market value of the companies they are analyzing. And depending on the company or sector, the relevant financial ratios will vary and the appropriate valuation methodologies will also differ. Last point for company analysis, but definitely not the least, we also want to know what are the risks or opportunities specific to this company. We want to know what we are supposed to watch out for, the downside risks and the upside potential, so that we can identify trading opportunities. So as I said in the beginning of the session, this afternoon, we don't want to be overwhelmed with the formulas and numbers, but we would still like to make these ratios easier to appreciate and recognize. So if we think about it, the most commonly used ratios fall into just a handful of buckets. So we have growth ratios, where we think about business expansion from one period to another. There's also profitability ratios. So here we have the likes of gross profit margin, operating income margin, net income margin. These are various levels of profit measured against the revenues, or it gives us an insight on how much peso profit does a company make for each peso of sales. There's also return on equity or ROE and return on assets or ROA. These in turn ask how much peso profit does a company make for each peso of equity or for each peso of assets. The next bucket is on efficiency. These are, sometimes people call this activity ratios. So these are usually in the form of turnovers. These measure a company's ability to convert its resources into income. So we have asset turnover, inventory turnover, and receivables turnover. Next would be liquidity ratios. These measure the company's ability to sufficiently pay off short-term liabilities using liquid or current assets. The keyword here would be current, meaning if these short-term debts come due today, does the company have readily available funds to pay these off? And the next bucket would be leverage. So here we have the debt to equity ratio. It is an indicator on how reliant a company is on debt versus on equity. And there's also interest cover, which tells us whether a company's cash flow can sufficiently address interest expense. So again, don't worry, the formulas for these ratios are very easy to look up on the internet, and they're also discussed in more detail in earlier sessions of TradeTalks. So we finally get to valuation. Again, we only hope to firm up the concept here, so we won't go into the detailed steps. Valuation approaches are normally grouped into two, absolute and relative. More strictly speaking, absolute valuation tends to be more fundamental because it models it approximates the values of the company on a standalone basis. For instance, in the asset-based model, we have net asset value. So this is typically used for property companies, for which analysts consolidate the values of their land bank and other properties. Net asset value it's just assets less liabilities divided by the total outstanding shares of a company. Another approach within absolute valuation is income approach. So here we have the very famous discounted cash flow model, or DCF model. The discounted cash flow model looks into the projected cash flows of a company and seeks to compute for the net present value of these future cash flows to arrive at the company's equity value. Because it requires forecasting future flows, the use of this method is normally limited or applied to stable companies that have already established very predictable and easy to estimate cash flows. So because of that, this normally applies to companies in the utility sector, well-established consumer names, and retail. Another method under income approach is the dividend discount model, which is very similar to DCF, except it uses expected dividends instead of projected cash flows. So because of that, it works better for companies with more predictable dividends, such as REITs. So the first type of valuation is absolute valuation, the next one is relative valuation. This type relies on multiples that are hinged on price, on market price. The most common multiples used, especially in the Philippine market, are price to equity, price to book, and EV/EBITDA. So price to earnings is probably the most popular, perhaps because of how easy it is to compute, and the insight it lends is likewise very easy to understand. So we get the share price and divide it by the earnings per share, or EPS. So meaning we are comparing the stock price against the earnings allocated for each share of stock. So if we think about it, a P multiple, for example, of 5 times means investors pay 5 pesos for each peso of earnings. So because of its simplicity, and because most stocks will have a price and will have easily determinable earnings, this can be used for most sectors, including consumer. Next is price to book, or PB. Price to book compares the share price with the company's book value per share. This is normally used for banks due to their unique business model compared to other industries. So if you would recall, bank balance sheets, they hold significant assets such as loans, which generate interest income over time. Then banks also have significant liabilities such as deposits, which they then use to fund their operations. Due to this business model, a bank's book value can be a more reliable indicator of its financial health than its earnings. And the last one here is EV to EBITDA. So EV to EBITDA is largely similar to the PE ratio, except modified a bit to adapt for companies that are capital expenditure intensive, like those in the power or telecoms industries. So those industries have to spend significant capex, and the payback periods tend to be longer than other industries. So just a note on valuation, the 2 important takeaways in approaching valuation are: first, different business models will call for different methods, and second, absolute and relative valuation may actually be used together to improve value estimate. So just a quick checkpoint on our takeaways thus far. Fundamental analysis uncovers the intrinsic or fair market value of an asset. It is a useful tool for identifying opportunities in the stock market, and it involves the study of the economy, industry, and company. Since it is focused on company fundamentals, which do not change overnight, fundamental analysis is more effective for long-term investing, and it is not commonly relied on for short-term price action. Lastly, admittedly, fundamental analysis could be a lengthy exercise that requires processing a lot of information. Now, the good news is there is actually a wealth of resources on fundamental analysis within your reach through BDO Securities. So the BDO Securities Equity Research Team will analyze all this information for you and even summarize findings and forecasts into regular publications. These reports are available for download through this link. So that's https://www.bdo.com.ph/personal investments and research. You may access these reports from the research portal by logging in to your BDO Securities account. So when you log in, you will see something like this screen here. You will just have to look up research under tools. And it will take you to this page. So the research reports are listed here. In fact, it doesn't only cover reports on fundamental analysis. It will also have reports on technical analysis. So these reports are on fundamental analysis. We have Philippine equity strategy, sector reports. Sector reports meaning thematic pieces on specific sectors. Company reports, which are of course company specific. Weekly wraps, which summarize what has happened in the past week, while also providing tips on ideas on how you may want to trade for the succeeding week, and daily digest, which is a more granular version of the weekly wrap. So I would just like to show you a couple of sample reports. I want to take this chance to highlight where you can find the things we just talked about in the research report. So take, for instance, the company report. So we have here published after a publication after Jollibee announced its first quarter 2024 results. So, and over to the right part of the first page, you will see a small table here on key stock data. So we have here the closing price, which is 222 pesos per share as of this came out May 15th. So the closing price as of May 15th is 222 pesos per share. This is the market price. It also indicates here BDO Securities target price or TP for this stock, which is 300 pesos. This represents the fair market value estimation of BDO Securities. So because the fair market value of 300 pesos is 35% higher than the market price of 222, it has an upside of 35%. And we know that because the fair market value is higher than the market price, BDO Securities rates this as a buy. If you scroll further down to the end of these company reports, there's usually this summary on their valuation study and risks to their estimate. So it explains here, for instance, it says our TP of 300 pesos. So that's our fair market value. It's based on a DCF methodology. It also explains what specific valuation method was used in arriving at this price, and even indicates here the assumptions such as the weighted average cost of capital and terminal growth rate. So these are assumptions that go into the DCF analysis. And of course, it also includes company-specific risks. So these are, as mentioned, these are things that you have to watch out for that might impact the fair market value estimate of the analyst. Okay. The research team also publishes what's called Philippine Equity Strategy Report. This report takes investors through the whole exercise of fundamental analysis. So it makes a commentary on market macroeconomic factors and their corresponding impact to the overall market. So part of this report, it also covers sector-specific insights. So like here, given the macroeconomic backdrop, then these are the recommended sectors to look into. And of course, takes it even further to also provide company-specific recommendations. The report also conveniently summarizes sector-by-sector views, complete with top stock picks to provide investors with a comprehensive Philippine equity strategy. So this report is normally published after every earnings season, so sometime after quarter end. Okay, and now one final tip. So some of you might not have the time to look up the Philippine Equity Strategy Report, or maybe you don't want to wait for the next issue of Philippine Equity Strategy. So one easy tip for you is that every Monday, BDO Securities actually sends to your inbox weekly investment ideas. So these come with a weekly wrap. So again, the weekly summary of what has happened in the market, and also includes insights on stock pick recommendations, which you may use for the week ahead. Okay, so that brings us to the end of this webinar. But before that, just want to summarize against the session objectives earlier. So first is what? Fundamental analysis aims to pin down the fair market value of an asset. Potential discoveries of pricing mismatch helps investors identify market opportunities. Fundamental analysis is an extensive process involving deep understanding of economy, industry, and company. These are normally modeled and quantified using various ratios and metrics. And for now what? However, there are tools within our reach. BDO Securities have processed all this information for us. And I hope that with this afternoon's appreciation, more investors would better absorb the implications of market data and analyst recommendations.
Thanks, Bettina, for that informative and comprehensive presentation. We're looking forward to the questions that our attendees are or will be asking. And with that, we will now be proceeding to the Q&A portion. However, while we are still waiting for our attendees to type in their questions, we'll first go through some of those we have received in advance. I guess this question also alludes to one of the questions here in the Q&A box from an anonymous attendee. Um, the question goes, how can one learn fundamental analysis effectively if they don't have any formal finance or economic education? Is there an easy or an intimidating way for beginners to start?
Okay. Um, Actually, formal finance or economics education is not a strict requirement for conducting fundamental analysis. What you would need is really maybe first would be, a strong interest for the factors that come into play. So maybe you would want to, you are interested in reading through the news, looking through economic data and analyzing how these information can actually impact specific sectors, specific companies. So I would say the least intimidating way to begin or try out fundamental analysis would be to read through news in partnership with reading research reports, because then you read through the news, you know what's happening, and then reading the research reports will actually like give you an idea of how does this actually translate to you know impact to specific companies and eventually to specific stock price movement.
Yes, I think that's a very great advice. There's another question here from an anonymous attendee. Hello, student here. Paano po mag-start ng career as an analyst sa stock market? Is there any certification needed for the job? Thank you.
Okay. Actually, there is no required certification for the job. Of course, you would like Rachel here is a CFA, but it is a plus, but it is not a requirement. So again, the most important thing would be strong interest in the practice, strong interest in finance, and the willingness to actually go through that lengthy process of analysis.
How about for people or for those who are already working and have 9 to 5 jobs? 9 to 5, yeah.
Mhm.
So how much time on average should this type of investor spend on researching stocks?
Yeah. So of course, if you're maintaining a 9 to 5 job, you might not have a lot of time to like go through all of that. Plus, the amount of time will really vary on the levels, because of course some of us keep 9 to 5 jobs in finance. Some might be in totally unrelated industries. So of course it will differ. But in terms of readiness, it will really boil down to interest and familiarity with the concepts, familiarity with the computations that go into it. But I think an important thing to note about the formulas, I would say that the appreciation, the understanding of the underlying concepts, that would be more important over memorizing all those formulas, because these things you can actually look them up. We're no longer in school. We can actually check books for this, look it up sa internet. So it's more important to know what metrics are actually available at our disposal to use in the analysis.
Mhm. Okay, talking about valuations, you've touched on discounted cash flow. There's a question here from an anonymous attendee also. There is a large variability in the discount rate used for discounted cash flow methodology. What are some guidelines that you follow to estimate this rate?
Sorry, Rachel. I think I missed the last part of it. Could you?
How do you what are the guidelines that you follow when you're estimating a discount to use for the DCF method?
Okay. Guidelines. So, just a bit of overview. The discounted cash flow methodology first will require you to have a forecast of financials. So, in practice, analysts would want a minimum of about 5 years forward-looking projections. So the first in coming up with those financial projections, one would need a firm grasp of how that business, how that company actually runs, what's the business model, the inputs that have an impact on its expenses and the outflows, the inflows as well. So like what impacts revenues. So again, profitability. And then apart from that level of, of course, there would also be the question on operating profitability. So then you would have the admin expenses, the overheads, before you could actually get to the free cash flow. So I guess when you do DCF, so you are looking to compile the net present value of all those future free cash flow, and then discount, well, net present value discounted to the present value. So another important assumption involved in the DCF method would be the discount rate to use. So I'm not sure if it was mentioned earlier, but there's the discount rate that's usually referred to as weighted average cost of capital. Each company will have its own specific mix of debt and equity. Each company, depending on its stability, will warrant certain interest rates. So that would be the cost of debt, and depending on where we are in the market, the current state of the market, there would that would also have an impact on the other factor there, the cost of equity. So all those things come into play. And when an important thing to consider here is those numbers, however small, the most like even the smallest blips can have a very big impact to the projected future cash flows, and of course, ultimately the resulting valuation.
I guess just to add to that, when you look at the discount rates relative to using the discounted cash flow method, right now we're experiencing a high interest rate environment. And whenever that happens, the risk premium that equity holders require would be higher. It's because if you look at the bonds right now, the interest rates for a 10-year Philippine bond, sovereign government bond, is at about 6.7%. So if that's what we call risk-free, then if you look at equities, which is a more risky investment, then equity holders would be requiring a higher rate of return. And that's why valuations tend to fall when interest rates are high, because the discount rates also are higher. So I guess that's how interest rates impact valuations of stocks. Now I think going to relative valuation, is PE ratio only essential in choosing a company in the same industry? Or can we only use PE ratio when comparing company to its sector peers?
Okay. So it is most reflective, most effective when compared within a sector because the we go back to the industry analysis. The factors at play are very similar when you're within an industry, but that doesn't stop you from comparing it with a stock in a different sector. Like that could also work.
And another question here, what accounts for different evaluations like fair market value, buy or hold or sell rating, etc.? I think you touched on this earlier during the presentation, but could you give us a short summary of how we evaluate whether a stock is overvalued or fairly valued or undervalued?
So, okay, the basic premise is you compare the fair market value with the market price. Uh, when we see fair market value, we have to, maybe an easy way to look at it is fair market value per stock, per share, compared with the price per share of a stock. So, depending on like if the fair market value is higher than the current share price, then that would be, probably a good buy. And conversely, might call for a sell recommendation. I understand, and correct me if I'm wrong, Rachel. I understand for BDO securities, there's you have this threshold of calling a buy or a sell a sell in a stock. So of course, the prices won't always be equal. So research firms will have thresholds for making a buy or a sell recommendation in a stock. Uh, Rachel, for buy, it's usually an upside of how many
15,
percent?
15%.
15%.
Mm.
And for sell,
Per sell, if the if there's a downside of more than 5% to the current market price, then we typically rate hold or neutral if the upside is less than 10% or within that band, -5 to 10%. Okay, so there's a question here that I'd like to address from Mr. Harold George de la Cruz. What type of stock or company do you recommend for a beginner investor? I guess, Bettina, you can also add to this later. But well, the general advice is really to start with companies that you where you avail of their products or services. For example, if you go to malls, then you can observe the how malls generate their revenues. So you can look at probably SM Prime or Ayala Land or even Mega World or Robinson's Land. So the general advice is really to check which products or services you usually use, then you'd be able to better understand how a company generates revenues. So, well, for us analysts, usually the starting point is in the consumer sector because it's easier for us to understand the business model since we are consumers ourselves. So, Bettina, do you have anything to add to that?
yeah, I totally agree with Rachel's recommendation because when you are actually a customer for the product of a certain company, you have an idea of, yeah, I guess a bit of an idea on how uh that company actually makes money. So um maybe to add to what Rachel said, um I would say that if you are just trying it out, definitely go into industries that you know about because some industries are admittedly more complicated than the rest. Maybe don't start off with those. So the easier ones would be something that maybe household names or products and services that you actually use.
This is in relation to company analysis. Hi,
Mhm.
I would like to inquire what are the common misconceptions when doing company analysis. Furthermore, I would like to ask what are the common problems when doing company analysis and how would they be addressed?
I would say common misconceptions would be uh, a fundamental analysis would look into the specifics of a company, and so that's something that we have established. But uh, I would say that maybe don't stop there. It is still very important to look outward and compare with the other options in the market. Um, Common misconceptions, I would say more usually pertain to like sentiments on price, which are again which what fundamental analysis tries to actually address,
Mhm.
to not be swayed by sentiments or other external factors that can't actually impact the underlying value of company.
I guess for me, a common misconception is that a company with good financials is also a good investment. I think we also have to look beyond financials because there's a lot of things that cannot be quantified. For example, the vision of the management, the branding, customer loyalty. So that's something that investors would also have to take into account, just not look only in the financial statements because sometimes we tend to rely on the most available information. But it would be better to have a deeper dive on the company as well as especially the vision of the management. Now,
Sorry,
is there
Rachel,
a
maybe
difference? Sorry.
maybe just to add a little bit, when looking into a company, maybe you already have a conclusion following your company analysis. It is also important to note that your conclusion may not hold forever. So, in addition to the qualitative factors that Rachel mentioned, it is also important to consider economic cycles, business cycles, because sometimes companies will fare differently. Even if you're a very well-managed company, you don't know, maybe certain factors will affect you adversely as well. So just because you came into the conclusion today that, this company will perform this way, um, it is still worth looking further into, as these dynamics change.
Mhm. You talked about economic cycles and maybe this is something that we are all familiar with. How does inflation affect the stock market?
Okay, so looking back to like what we had earlier discussed, uh, maybe a good way to think about it is what does inflation actually do when the prices of goods, when when consumers would need more money to be able to afford the goods that they normally consume, uh, then the buying power of the people are impacted, then it could dampen demand for certain products and services. So, and that effect will, uh, not just affect certain companies, but will also extend the impact will extend to other other players within that value chain. So, um, yeah.
I guess circling back to the process of doing fundamental analysis, you talked about stocks. Can this process be also applied when valuing, for example, bonds or property?
Oh, definitely. Because fundamental analysis is interested in foundations of value. And both bonds and property have that too. So fundamental analysis would also apply, except the drivers might be different. So for example, for bonds, maybe one would be more interested in looking at the current interest rate market, interest rate outlook. And also, so for corporate bonds, then you would also be interested in the credit rating of those companies.
Bettina, we only have we only have time for one more question. As someone who have experience in the different fields of finance, could you share with us what are things that aspiring investors can do every day to know more about fundamental analysis?
Okay, I'd have to say the best tool would be building familiarity with the concept. So I would suggest maybe spending 5-10 minutes of your time every morning going through reading the news. I believe it's good discipline, and so again, as mentioned, I, at the sake of repeating myself, it would be good to practice always reading through the news, and then reading this in partnership with research reports, just so we establish the connection between market developments and how these will actually translate to impact, company-specific impact.
Thanks for that, Bettina. So I believe this is all the time we have for our Q&A. For those questions that we were not able to answer, rest assured that we will get in touch with you to discuss this accordingly. Thank you to all our participants who took the time off this afternoon to join our webinar. This was certainly a very productive and insightful discussion. We hope that you will be able to join us again in our next Trade Talks tutorial sessions. Thanks, everyone. Please stay safe and enjoy the rest of the day.
Trade stocks online with BDO Securities anytime, anywhere. With BDO Securities' online trading platform, you can easily open an account, do real-time funding and withdrawal, and stay updated with market insights and trade ideas. All these to help you make informed decisions as you grow and manage your wealth. Whether you're new to investing or a seasoned investor, BDO Securities will give you access to a comprehensive stock market experience. Visit www.bdo.com.ph/BDO-securities to open an account today. Trade stocks online with BDO Securities anytime, anywhere. With BDO Securities' online trading platform, you can easily open an account, do real-time funding and withdrawal, and stay updated with market insights and trade ideas. All these to help you make informed decisions as you grow and manage your wealth. Whether you're new to investing or a seasoned investor, BDO Securities will give you access to a comprehensive stock market experience. Visit www.bdo.com.ph/BDO-securities to open an account today.